We found a property we wanted to buy. That was a 38 plex. We bought the 38 unit with $0 out of pocket.
Because we had $0.
So, build phase is number one. And in the beginning, what we specialized in and really focused on was my job of building the portfolio. You establish what the target is and then what the cost associated with that is. So if you want to get a $1 million house and the rates are high, it's going to cost you $8,000 a month. You're also going to have taxes, and then you're going to have a cost of living. So you probably need to budget for $25,000.
Mm-hmm.
If your goal is $25,000 a month, $300,000 a year, you need $5 million of equity paying you 6%. That's the math. So you establish the goal, figure out what's the cost. Now the quickest way to get to $5 million would probably be to buy $10 million of real estate and get to be worth 15.
Mm-hmm.
Now how the heck do we do that? Because that's exactly what we did to hit our objectives for cash flow, for the equity growth that could pay us in the future. We found a property we wanted to buy. That was a 38 plex. We bought the 38 unit with $0 out of pocket.
Because we had $0.
I had $3,000. So.
Oh, okay, well fine. We had some money.
Boy.
You didn't spend your $3,000 though.
Fact. We found the deal, which is step number one in build phase. You find something that could actually move the needle for you. And if you're trying to get to $20,000 a month, you're probably not doing that buying houses. You establish the asset class. We picked multifamily. That's how we built multifamily strategy. Next thing in that cycle of build phase is you actually have to source the debt. The debt is the cheapest form of money you can get. If people give you a check for equity and they want to be a partner, they want all the upside and the benefits down the road. And if that asset goes way up in value like ours did, they'd be entitled to all those benefits. So you want to get as much debt as possible that is supported by the property. In our case, we talked about seller financing. This property that we bought, it was listed on the MLS. It got listed when I was in 3rd grade and I bought it when I was 21. Same list price, $2 million. My thought was, wow, that was a big problem back then. Today, 38 units for $2 million doesn't suck in Washington State.
Not at all.
So I figured the price wasn't the issue. The problem was it didn't make enough money to get a bank loan. Meaning someone's going to have to write a $2 million check in Moses Lake, which no one's going to do. No one's paying cash for that project. Or you're going to get hard money and take a super hard negative cash flow, which no one's willing to do in that market either. So what we opted to do is I called them up. It was not listed with this. Asked them to hold a contract, and they agreed to give us $1.7 million at 4%. So we
Which is fantastic.
we made one phone call and had $1.7 million lined up. We bought it for $2 million. So the question is, where did he get the other $300,000? And with seller financing, just to preface it, the terms are all made up. If there's any ambiguity there, it is what you make of it. You can have a certain payment schedule for 3 months, 6 months, 12 months. You can negotiate no payments to make any deal work. But the first piece of money you have to line up is the debt, and then it comes down to the equity, which is something that Christian loves more so than me.
Well, when you get started, you can only, we'll talk a bunch about debt versus equity. When you get started, you only have so much cash flow to sacrifice, so you have to protect that cash flow as much as possible. Typically, the easiest way to do that is with equity, but you have to remember that if you're buying out a partner later, it's usually going to cost you more in the long run than had you used debt. So debt is a way where you can own all of your stuff yourself. Equity is a way where you can project for more cash flow over time. There's a couple of ways that we use this. On equity, if we have a deal, say it has a ton of upside. So this is like those management flips is a great example. If it's going to be a few years, so this isn't going to be a quick hard money loan. This is going to be, hey, we're going to take 2.5 years. We're going to fix the management problems. We're going to do some of the maintenance. We're going to get rents up. We have an actual project here. It probably doesn't cash flow well day one because it's mismanaged. So say rents are $1,000 in a market, we're buying something for $500 per unit. We're half of market rent. It's going to take time to get those rents up, and when tenants move out, as we start to raise rent, we are going to do renovations. Something like that, we're probably not going to use debt because we're going to bring that cash flow negative as income drops and as changes are made. So in that case, we'd use an equity partner. It's going to cost more to buy them out on the back end, but when you finish the project, you can either refi. You don't want to have to sell, but you can refi, you can restructure, you can pay them out of cash flow, you can pay them out of earned income, but you can buy them out at a future date. So what you get to do with equity is arbitrage time. If your goal is to own your real estate, you want to own the real estate, which means you don't want a whole bunch of long-term partners. The way to play the equity game is you have a set buyout at a future date, and that option is in your initial agreement. So in your operating agreement or in any of your financing agreements, you say, hey, we have an option to buy out at a fixed price within a fixed window of time. Going back to the 38-plex, talking about equity structures, we brought in 3 partners.
Which was a mistake.
Yes, which was a mistake. $100,000 each. We should have found one person with $300,000. That was just a function of being young, going like, how on earth are we going to raise $300,000? That feels like a lot of money. For a $2 million purchase of an asset with that much upside, it would have been very easy to find one person at $300,000. We did not do that. That's what we should have done. Realistically, we should have found one person at $500,000 or $600,000, so we have enough money to start the projects and then buy them out. Another thing that we did wrong, all you note takers, this cost us about $150,000 to $200,000. Your entire event is worth it if you learn this and don't make the same mistake. When we raised them, we did a 5-year buyout. We're going to double everyone's money in 5 years. That's the price of the capital. What we ended up doing was 6 months in, the project went really well, and we wanted to refinance. To start the refinance, we made the decision to buy everyone out. There was no staggered buyout. So there was no, if we do it in 6 months, we still have to double everyone's money. So we had to buy people out at a 2-to-1. And some we negotiated for like, hey, we're doing this like 4.5 years early. Can we get a little bit of a reduction?
They didn't have to say yes.
They did not have to say yes. A lot of people went like, well, that's a good deal. In 6 months, you're going to give me like a 75% return. That's ridiculous. It cost us a lot of money to structure that way because we bought out people in 6 months at or near the 5-year buyout price. So if you're using this strategy, I would structure a tiered system with very specific things of, hey, if we buy you out before this, it costs X. We have different systems for different projects, but we've had some where it's, if we do this by year 2, the price is here, which gives us some incentive to get a little discount for cheaper money if we rush through the project. If it takes longer or we want to extend, there's an option at 5 years. What I found is most effective is at the end of the year have a fixed price. So if we have a 5-year project, there's an option to buy out at year 1, 2, 3, 4, and 5, all at fixed prices. That's going to super simple to draft and can save you hundreds of thousands of dollars. Like that, there's multiple times in our business we could have used a few $100,000 and
Even today.
yeah, that's so that's a big one. But when you're doing equity, the message is it's probably going to cost you more over time, but we invest in properties based on cash flow for that equity growth. Earlier you talked about this.
Yeah.
$10 million property, how do we increase the value $5 million? That's the end goal. We cannot sacrifice cash flow in order to do so, especially if you have no money, because if you're out of money and you have debts, that's how you lose the game.
And we will talk about all the math on this after lunch. We do have a specific section for that. Today we're just talking, like right now, it's just concepts. Now another thing on this deal, a mistake we made. We gave up 60% of the project for this money. When we cash them out, we have to pay this thing called excise tax because the government likes to take their cut if over 50% of an LLC trades. Doesn't matter if the asset trades, we traded half the company when we bought them out.
Oops.
So that was not only more money we had to give out day one to the investors, but we had to pay the government. That stinks. The cool part about it was we bought that position back. It was like $460,000 when we settled out with all the investors in 6 months. We did not wire a dime of this. Because not only can you seller finance buildings, you can seller finance out partners. We called up all our partners and said, hey, we got the project starting to cash flow. It's going to take a little bit longer to actually make money. And it did take about 18 months to really get it stable. And now it's actually starting to cash flow 6 figures a year. But this was like a year and a half ago that we first made this proposal. It was going to take a little while to get it to cash flow. And in the beginning, we bought it, it was negative, we got it to break even, make a little bit of money. Anytime you make more money, you can borrow more money and get it to be covered by the asset. Problem was, we were 2 youngins and the bank did not want to give us money after 6 months to buy out our partners. So if you can't get new debt from a bank and you can't further encumber a property because the seller says no further encumbrances, you can't get another loan, what do? You write a promissory note with the partners. You can contract anything you want in the US. You can absolutely write an agreement. So we signed a promissory note for these individuals, 10% interest at I think the average was like $150,000 for $100,000 in.
Mm-hmm.
And as a result, now we signed up for a new obligation. We had to pay them every single month. But we bought our equity position back early. This is the part with equity that I don't like. If we do all the work, we don't get all the benefit if we have to share it with a whole bunch of people. If you don't have fixed buyout agreements, if you don't fix your terms day one. We bought the asset for zero down, and we wrote a promissory note to our investors to buy them out within 6 months. The asset covered the payments, and we got 100% of a building. When we went to a bank later down the road, we got it fixed up. Christian mentioned earlier in our little chat that we pulled out $300,000, we put it back in the building, pulled another $300,000. We've got about $2 million of equity in this building today. We would have only had 400,000 of that each. But today we're each millionaires by that property alone because we said we're going to get it to operate just well enough and work with our partners so that they can sell or finance back their ownership.
And so that's one of the big messages with creative finance is you can convert debt into equity and equity into debt. When you need cash, people can buy into your LLCs. We rarely do that because, again, we want to own everything. But sometimes you need a capital injection. I don't want to sell the asset. I will sell a piece of the ownership of that asset to someone to recapitalize. That is a way that you can bring money into your org. Again, equity comes at a cost. Buyouts are fixed. We have very few partnerships that are designed to be very long-term, Cody and mine being one. Everything else, fixed buyout, fixed set of time, fixed period of time. This is exactly how we're going to execute them.
Now, the fun thing about this, so we ripped out about $600,000 and fixed up the asset. To this day, we've never really paid ourselves cash flow out of the building, but we made this huge value add. For folks who are looking to get a little bit of an advance on their cash, we needed money. We structured this deal. We'll talk about additional down payments a little bit later in this discussion, but you can get really low down deals if you do extra down payments in the future through the prom note. We signed up for a couple of those, and so we needed money. Mm-hmm. Our strategy is built off of meeting with players in the space. You meet up with real estate owners. We made some good friendships with people that owned real estate, a lot of real estate, hundreds of millions of dollars of real estate over in Grant County. They're just factually bigger players. We let them know our situation, and they said, well, don't sell the whole asset. What if you own 100% of this? What if you just sold me 49.99%? So we actually went to them and traded our equity out and got a $550,000 check, which allowed us to expand all of our other businesses. You can convert debt into equity, like Christian was saying, and equity to debt. So if you're doing a value-add deal like this and you want to keep it, one thing you can do is if you're meeting with investors along the way, you don't have to just have your partnership figured out day one. If you know somebody that's in the real estate space, they can become a partner in the future just by buying in, giving you the cash you need to do your other ventures.
Mm. And it's all just about protecting cash flow and available cash. If you have a balloon coming up, you have some debt that's due, that of course means a lump sum of cash. You can borrow it, you can earn it, or you can trade equity for it. And we've done a mix of all of those things. The important thing is you have enough cash to pay your bills and you have enough cash flow to service all your recurring income. If any of those things get off, which happens, we've had these things get unbalanced before in our portfolio, that's where you take a step back and you go, what pieces are we missing? What pieces do we have? When I talked about switching from duplexes to 38 plexes, 12 plexes, larger buildings, this is why it's so important to scale your business. You need to get enough pieces on the board as you have more properties, different partners, more money, more cash flow in. You have all these different things that you can actually adjust and play with your pieces.
All right, so the next deal we're going to talk about, Southtown 12. So we bought this.
It's like, do you manage the cash flow per property, or do you look at the cash flow of the portfolio as a whole when you're doing these trade-offs?
Every property has to fend for itself. It has to be able to self-sustain. Now, globally, you'll have positive cash flow or negative. It depends on your strategy. And we know some folks that built their strategy off of negative cash flow but appreciation. And that's fine if they make global money, but in our model, everything should have a clear path to cash flow positive.
Now, the exception to that is when you have enough global cash flow, you're allowed to take on a few projects that may start cash negative if they're a larger project. For example, we're doing a 24-unit hotel conversion. On that hotel conversion, we have to kick everyone out to do the hotel. That does not cash flow with no income. Just
but
for
we
anyone who's doing
negotiated
that.
3 months of no payments.
Yes. So we were negative the utilities to operate the building, essentially. It's a light negative for a short period of time. You're allowed to do that because that's a specific project that's supported by the other ones, and it has a quick 3-month process to start releasing, getting people in there and get the income back up. So you're allowed to play with it a little bit. If that was our first deal, we wouldn't know what to do. We don't know enough. We don't have enough global cash flow. That project's off the board. That's the only exception, is if you have global cash flow, you can do a couple of projects on the side that dip negative, whereas you can't do those when you're earlier without enough global.
Now this is a fun deal here, because this is something that anybody can do. A mistake we made along the way in our journey was we realized there's this thing called basis in a property, and there's there's allocations that you get when you're an owner of something. And if you have no money and you've got no basis in that deal, that can make it tough for tax time, especially if you want your capital accounts to balance. So we only made that mistake like 3 times and had to backtrack with the government and figure out what we didn't know. And so you can avoid that all by doing this. We bought a 12-plex with $0 down, but we had a perfectly matched capital account. We had a partner named Trevor, and then we had Cody and Christian. We went 50-50 on the deal. We had $0 into this deal, but we had a perfectly balanced capital account. We needed, this was $225,000 down?
Yes, it was.
Okay, so it's $225,000 as a down payment on a project that's going to cash flow about $5,000 a month. It's here in Washington, it's seller financed, 12 units, and the payment's only $3,000.
So before you go on, what do you mean by you had a balanced capital account?
It means everybody contributed the same amount of money.
You put 0 in.
We put 0 in. This is where it gets really fun. They had about $250,000 in the bank, and they wanted to invest into a cash flowing deal. So our share of the 225, and with closing costs, it was closer to 240, is $120,000. So what we did at closing is we did half of it, where they did an equity contribution, and they lent us the other half.
Oh, so it looked like you did an equity contribution. You just did it.
But it is an equity contribution.
Yeah.
It's just we borrow the money. The fact that we can pull money out from someone, doesn't matter if it's the same person or not. Now we have an equal contribution, and the cash flow from the asset makes our note payment.
Yeah.
And we buy based on cash flow for equity growth. So we bought it a little bit below market value. We have a chance to get it up, and once we refinance it, if we don't pay them off early, everybody gets the money out, and we'll take our money and cash out the note to them.
We'll do another event early next year that is all focused on asset management and optimization. But when we get into like the cost segregations and maximizing your tax benefit, you need to have basis in the property. So 101 level, outside basis is your actual equity that you own. So 50-50, outside basis. Trevor has 50%, we have 50%, which means each of us have 25%. Logically, you might think like, oh, well, I get 25% of the actual benefits. And technically you do. They're assigned to you. However, you cannot claim more money against your tax return for that year than you have in the deal. So if you have $0 in the deal and you didn't borrow and put in anything, it shows up on your tax return. It will roll over into next year, but it doesn't actually save you any money, which was about $100,000 of taxes that Cody and I thought that we would not have. Surprise! Going into next year, it'll be a lot better because that rolls over, and that is 2023 is the year where we did about $600,000 of renovation on one of those buildings. So we'll find it, but you can't actually claim it. Writing an extra $100,000 check when you don't expect it is a bummer, which is why this is a really good structure if you can support this, where you borrow the down and the equity. You blend the two, and you're good to go.
And when I bought my very first deal, I didn't understand this. I didn't have to because I borrowed all my down payments. I didn't do equity partnerships. I didn't realize that, this happened. So we actually did this in my 3rd year of investing, our 1st year of investing together. That's where we made all our mistakes. But one way you can buy real estate, my very first 12-plex over in Quincy, it's now a 13 unit. I got the seller to finance $1 million. Payment was about $6,000 a month. And I borrowed the down payment, which cost me $1,250 a month. My total mortgage all in, with PI, TI, and then the second mortgage, was right around $8,000, and the property made $9,700 a month. There are some deals out there, not as many in Washington anymore. I used to do this in Central Washington, where you could do 100% debt, and it'd be really easy. But over east, you can find those types of deals where you borrow the down payment completely, you have no partners, and you can buy real estate like that, first lien, second lien, and you don't have to worry about any of this. Because you borrow the down payment.
Who are you borrowing the down payment from? Are you borrowing it from the seller? In addition
You
to-
could borrow it from the
Who
seller.
are you borrowing it from? Like
Ah.
just outside folks? Or?
Yeah, so our whole strategy is built off of meeting with owners. The owners in the market are the most knowledgeable people in that given market for real estate. They also happen to be investors. The 24-unit hotel conversion, the guy who funded that down payment, we got a seller finance for the first, and then we did this strategy on for the rest of the down payment. The guy who funded it is our property neighbor. They own the 40-unit hotel next door. And they've got a couple $100 million balance sheet. But we got connected with them just by a cold call saying, hey, this is who we are, can we grab coffee?
Nice.
So we funded a few deals like this where you do half of it is debt, half of it is equity, but you have to make sure that the payments going out are covered by the income coming in. Because if you go negative on your first deal, your second deal, that can absolutely tank you, and you don't want to go bankrupt over a duplex or a fourplex.
Mm-hmm. Putting together deals, by the way, this is super simple, and you've probably heard this if you've seen any of our content anywhere ever. But DDE, we always follow this model. It's deal first, then the debt, then the equity. And if you don't need the equity, it's only deal, debt, and more debt until you get it 100% funded. So we have D, D, E.
And we'll talk about this for the Robinhood.
Yes.
Because we're in the Robinhood. So we'll do it for DDERH. That's an H.
Don't question it.
All right, so we bought this project for $4.5 million. I promise you, Christian and I didn't have $4.5 million laying around. We still don't. But that's the amount of money we needed to buy this. And so the first thing is you find your deal. So that's step number one. We found it. It's here. The next thing is the debt. The debt's the big piece of the money. This is also the cheapest piece of the money that you can possibly negotiate. Because even if you've got the down payment, if you put the down payment into this versus something else, what's the opportunity cost? So there's always going to be a higher cost on your equity. The debt that we negotiated here was $3.5 million. We were sitting here. They had a $10,000 couch here.
Yes, they did.
They love their furniture, but we were sitting on their couch, and they said, "Well, did you bring a suitcase full of cash?" I said, "Yeah, let me go get it." And then they said, "No, seriously, what do you guys think for this? How much could you put down?" And so we thought, what if we did $450,000 down? And they said, "Well, what about $1 million?" I said, "What about $450,000?" And they said, "No, we're going to do $1 million." So we had to come up with $1 million. But what that did tell us is they're willing to give us $3.5 million. That was the biggest ask we've ever had. Most amount of money we've ever had on a note at that point in time.
Mm-hmm.
So the nice thing is, we got, out of the $4.5 million, we had 3.5 already lined up. Debt was lined up at 4.5% interest. To own a resort, it cost $13,000 a month. On the debt, anyway. And the last piece was the equity. And this was a fun part, because we had to raise 7 figures. And we did it in 7 minutes. It was our first phone call, one coffee meeting with one owner.
Now our thought was we're going to do this over maybe 2 or 3 people. Kind of like the 38. It's like, okay, well, I mean, this is a bigger ask. It's $1 million. I don't know that I have a lot of friends who are just holding $1 million. So I was like, we're probably going to need a few investors at $250,000, maybe $330,000 to come on in and get this thing fully funded. Which is, there's a really good lesson in this too. First person we met, they were like, oh, we like the deal. I don't know that I'm comfortable with other people. What would it look like if we just did all of the money and we just closed this together?
To which we said it looked like you're writing us a check for $1 million. And they laughed and said, well, let's look at it.
The lesson here is when you're raising capital or negotiating seller financing, ask for what you want. We asked them for $330,000. They gave us $1 million. The right thing to do would be present and say, we're trying to raise $1 million. We would like $1 million. We would have got a yes on that. Now this worked because we got a little bit of grace, but the right pitch is always ask for what you want, not what you think you need. Don't structure towards what you think you're going to get a yes for. Ryan knows this as a car salesman. You just go in and say, hey, this is what we'd like to happen. Let's see what happens. This was fortunate though, because the whole $1 million did come in 7 minutes. First ask. The larger your deal, and the simpler your deal is to wrap the head around, like even 38, it's like, what's wrong with it? Everything. Okay, good. We're through that. When you have a simple pitch, it's very easy, a very clear ask, the money will always find the deal, which is why we start with the deal. Too many people, get caught up in, I don't know where the money's coming, I don't have the money, I don't have $1 million. We sure as heck had no idea where the $1 million was coming from.
Never done that before. Ever.
Start with the deal though. We know the opportunity, we figured out the benchmarks, and the benchmark was, we want to cash out $1 million at this place. That was what the owner wanted. I want to leave to Costa Rica with $1 million in my pocket.
And they did that.
And they did that. All we had to do was figure out what debt and equity structure allows us to hit that goal for them and allows us to not lose the asset. How do we own it? How do we never lose it?
And for those who are getting stuck on the seller finance thing, you can literally do that on anything. The seller of this, they wanted to walk with legitimate $1 million. They seller finance the commission to the broker until we pay them off the other 3.5. You can finance anything you want, at least in the United States. So you find a deal, a car, you can do whatever you want. You can seller finance any deal, and all the terms are made up. It's not limited to working with vendors. But for the numbers, how we actually underwrote it, and
So how do you prospect for the $1 million? Where did your prospecting start?
we just go. We have a where's our money list, and
Literally what it is in my laptop.
So, okay,
Excel.
so-
Where's the money?
so it literally looks like this though. It's just a little Excel, and where money question mark, and what we do is we list out every single owner we've ever talked with, and if we have their goals mapped out here too. That's really important. It's one thing to get in the room with people, it's another thing to have their objectives mapped out, because when you have their objectives mapped out, you can establish which deal makes sense for that individual. For this deal, they really don't care about making money. The investor, they don't care about making money anymore. They just want to say, F you government, they don't want to pay the taxes. They're trying to get cost saves. That's their only goal. And while we don't think that is right, that's their objective. So we found a deal that hit their objective. And we actually gave them equity so that they could get their cost seg. It was called a special allocation. We're not going to talk too much about that today because that's complicated.
And don't do this.
Don't do this.
Yeah.
But we were able to match the money. And how we actually underwrote the deal, because even though we were able to match up with their goals, they're still going to want to see numbers. We negotiated the debt on the deal, but we've got our top line income, so income on the deal, and this is just something you should map out. It doesn't need to be some crazy spreadsheet. This is what people think it has to be. Like, oh, you gotta have all your spreadsheets and your KPIs. I've never pitched a KPI. I learned about that last year. So you have your income, and on the deal it was making about $620,000 a year. This is what the Robinhood did in the past. We were told, and we verified through bank statements, they just didn't pay everything through the bank, that their operating expenses, which is your OPEX, that was about $220 a year, which matched up with the bank statements. So we just thought, oh, that's accurate. So we were projecting for a $400,000, it's called an NOI, for those who are new, net operating income. That's the money you have to pay your mortgage and pay yourself cash flow. So we had a $400,000 NOI, and our mortgage payment was $154,000 a year. So our thought was, well, 400 is a lot more than 154. We should cash flow a couple $100,000 a year on $1 million down. That makes sense. So with our investor, we said, this is how we're going to be able to hold the asset forever. We have so much extra cash flow, and you guys don't want the income, so we'll allocate all the tax benefits to you. We'll allocate all the income to us. That way it's super stable. So an investor for the $1 million gets the write-offs, we get the income, and that allows us to service the asset. Now what we didn't know is that they were paying, this is recorded, so they were paying some stuff under the table, and that actually took the OPEX closer to 420, and we didn't know that.
And that also includes some deferred maintenance. We had a furnace that went out immediately. We had 11 trees on campus that we had to get removed pretty urgently. We had someone move out of one of the mobiles on the hill that actually came with the campus that needed a very full renovation, and we did some light work to the septic system.
Okay, so let me make sure I understood. So in this case, your investor became the capital owner.
They were an equity partner.
But how much of it? All of the equity?
So they brought in all the money,
Okay.
and we kept 40% of the asset.
With a clause to buy 100% of the asset over time.
Now you can structure your down payments however you want. The way we structured it, because we did not know hospitality. I'll flip it because the folks in the back, it might be hard to see down there.
Yep.
But talk about deal, which we're in the deal, we know what that is right now. We've got the debt, we talked about that. The equity is really important that you structure it right, because we've structured this wrong before and it's cost us a ton of money. We probably made $1 million mistakes by now, amongst all the deals.
Oh yeah, I'm sure.
So we had 2 equity structures with 2 different LLCs that they were affiliated with. We had $700,000 as an equity buyout at an expensive rate, meaning that every year it compounds at 18%. It was going to be 0 just for all the tax benefits, and then for some reason a week before close it went to 18. So you live and you learn. That went to 18%. We should have had our agreement signed earlier. That is just a compounding buyout. So the first year it went to like 820, and then it went to like 960, and then it goes to $1,000,001-ish. We had 300,000.
Wow, that's awesome for them.
So it's a compounding buyout over time, like basically had a 1-year clause, a 2-year
Yep.
clause, a 3-year clause.
Yeah, so we didn't have a fixed buyout like we did on the 38plex. $300,000 was at 0%. So that is just going to stay the way it is. So we had a total cumulative cost of capital of like 12.5%, which for a 0 down deal is not terrible.
It averages to about like the low end of hard money rates today.
Yeah, why wouldn't you do hard money on this?
No further encumbrances.
Yep.
So there's a clause in most notes, they're almost in every commercial note. If you're buying seller finance and you have a broker writing this up or you're writing it up, don't ever check this box. In Washington State, it's a Form 22C, but it's your seller finance addenda for your offer. And there's this thing called, it's NFE, or yeah, no further encumbrances. It's just going to be a little box. Make sure your agent doesn't check that, because if they do, that means you can't borrow the down payment against title. My first 3 deals I bought without Christian. Well, I didn't even know Christian. But I did that without partners because I didn't check this. I was able to put a second against title. When you're buying real estate, there's lien theory, there's title theory, there's intermediary theory, and that's another long chat for another day. But the way it works is you have your title to, maybe it's a 12plex, and you got your deal, and then there's debt and there's equity. Typically there's going to be, first lien is just a loan. It's the that it gets paid off in. So that lender, usually it's the seller, is going to be in first. So you have your first lien, and if you get foreclosed on and you got to sell the asset to pay off your lenders, that's the first person to get paid off. That's why sellers typically like to be in first. If there's a second lien, like my first 3 deals, then you could have a second down here. And the reason those are more expensive typically is because if there's not enough to cover the first and the second, you're left holding the bag and you lose money. We could have bought this deal with 100% debt. However, the agent, which was not our agent, we got represented by the other party because it was super complicated. They checked this box, so we could not put a second lien on the asset. We had to do what's called an equity partnership with a buyout agreement.
And the owner insisted on that. They didn't want us further encumbering the property either in the event that they had to take it back. They didn't want any other debt attached to it, which is not super uncommon. The fun thing with equity and debt here, though, is, again, you can kind of use them interchangeably sometimes. Notice most debt has a balloon. Our partnerships have buyout options, which looks a heck of a lot like a balloon. We have a set period of time in which we can buy someone out at a fixed price. There's a fixed return. You can structure equity to look a good deal like debt, like we did here with compounding payments. Now, granted, it's not affecting the cash flow because that's not a monthly output, which is really nice. But since we cannot raise debt in second position on this deal, we structured a product that looked very similar to hard money in terms of cost, except, and this is something I do love about equity, because it doesn't drain the cash flow monthly, all the payments are deferred to the future. So we actually get to run our project. We could have, for example, year 1, where you had CapEx items that you didn't expect to have in your first year. I could have a year where we had great income, but more expenses, and I didn't have to maintain monthly cash flow and end the year super negative. Instead, we about broke even, we're all happy, and we move forward into the next year with more knowledge and less project stuff to do.
Yeah, so the 300, could you pay that off at the end of every year?
The $300,000, we had an agreement with them. So they have two different entities. They have a lot of legal rep and counsel. So this is the entity that gets all the tax breaks. The way that the actual operating agreement is structured. So they don't want to be bought out
They
until
want to keep that portion.
until the 5th year and 1 day.
Yes.
Okay.
This one we can buy anytime,
Okay.
and they both jointly own 30% of the asset.
Gotcha. Okay.
Yeah. Which means when we buy them out, we will pay excise tax, which is a bummer, but that is
Cost of
what
doing
we
business.
Yep. You try not to do that. What we often will do is we'll do like 49.51 if someone is bringing all the money. That is where you structure, if they're like, hey, I need to have a little bit more security, that's where you structure the remainder as debt. So when we go ahead and personally borrow some of it, we go, okay, you're going to take 49% of the equity, but say someone needed at least 60% backing, at least 10% of it is going to be debt, backed by our ownership of the LLC. So when you can't encumber the property, you can encumber the entity. So there are ways around just about everything legally with debt and equity. When you can't do it in debt, you do it with equity. That's why we have the second D, debt comes before equity. If you can take a deal out using only debt,
Do it.
do it every single time. But you can't sacrifice cash flow and you can't break any rules to do so.
Now, for those who are in the room and have any creative ideas, what happens if we can't pay this off at year 3 and it's $1 million balloon?
Can you borrow other money to pay that money off?
Yeah, you could borrow from someone else, but let's say we couldn't go get a bank loan somewhere else. What would be a logical solution to fix that?
Another
Can you ask
property.
them to extend the term?
Could ask them to extend, but I don't know how I feel about $1.1 million accruing at 18%. It's kind of scary.
Would it be a refinance?
Maybe
That
refinance.
would
What if
work.
we couldn't refinance this asset? Maybe rates are 10%.
Second position note on a different property.
Second position note on a different property. Maybe we could take a HELOC out.
A new equity partner for the same property, just different terms.
Yep.
I love that, yeah.
We have that hotel conversion over in Mose Lake. The person who financed that owns tons of hotels. They just bought the Tacoma Dome Comfort Inn, the adjacent property to that. We've actually had the conversation of what it would look like for them to buy out this position without a balloon. You can do a buyout agreement. However, we want to own this forever, so how else could we do it? And this is the question we always ask ourselves. The beauty of creative finance, you can do whatever you want. You just have to get the idea. Realistically, what we do is we try and figure out how do we come up with a down payment on that if we had no money, or no extra money to pay off the whole thing. If we could come up with $200,000-300,000 and have them move the collateral somewhere else. If we really wanted to own the Robinhood so we could pay it off, how do we trade, just like Christian and I?
Mm-hmm.
He traded me ownership in a sixplex for ownership in PM. That's why it's so important to get pieces on the board. Whether it's Southtown 12plex, whether it's the Robinhood, when you have a whole bunch of pieces, you can move them around and you can exchange with people that want that particular type of deal.
At the end of the day, how do you pay off debts? Anyone can answer.
Who knows?
How do you pay your debts?
With money.
Exactly right.
Okay.
You pay your debts with money. Where does the money come from? Well, you can get it from selling the asset, but we don't want to do that. We don't want to have to do that, but it is always an option. So that's in your back pocket. You sell the asset. You have to have enough equity to cover that debt, but that is a way number one. Two, you earn it. We could just go out and earn $1,150,000 and pay them off in 3 years out of earned income. Assuming that you don't have that in excess savings, you can go ahead and refinance, which is the most common way throughout all real estate that people do stuff. You get the value up over time, you use the debt to arbitrage time, and then you come in and get new debt, pay off the old debts, and away you go. The other thing you do, and Cody and I do this a lot, is restructure. And in seller financing, this is really important. If you have a debt product that you love and a prior owner who's seller financing to you that you love working with, when we come to balloon time, I typically would rather restructure with that individual than pay them off. I'd rather deploy the cash somewhere else. We do this often. We come to the owner and we go, hey, things have been working well. We've hit a lot of these metrics. This has gone very smooth. Do you actually want to be paid off or do you want to extend? It is not uncommon for owners just to say, I would prefer to extend. So if we have awesome terms, say 4.5%, someone could just say, yeah, I'm fine with this. Maybe we bump it to 5.5%. Rates have gone up. It gets a little bit more expensive. But instead of having to go out and get new debt at 8.5%, we could extend a note at 5% or maybe pay a little bit down on it. You can do the same thing with the equity. It's very possible. I don't want to owe on $1,150,000, I don't want to owe that, but say we got to the end and we had 500,000 liquid. Say we actually missed this. We're at the end of our balloon. You can have that conversation. If we gave you $500,000 right now, we could either back it by another property, or what if we wrote a new note, have another year, you get half of it right now, and you get 18% on $500,000 or whatever is left over. Restructure is an option that you usually can't just come to the bank and say, hey, can we get new terms? And I've written the terms out, they work for us. Can't do that with the bank. Creative finance, you get what you negotiate. Restructure happens all the time, and it is usually some iteration of that is your best option.
Now, one other deal that we will talk about before we go to Q&A is Gibby.
Ooh, the Gib.
The Gibster. So we bought a development site. I'm super excited about development, and we're going to build a sixplex on the back of it. Right now it's a duplex, so we're going to put some brand new stuff in the back. The deal is, though, there's no equity in that building, really. So we've got this twoplex over here that is seller financed. I've got a different building that I don't own with Christian anymore, and it's a sixplex. I have a seller note on it of $280,000, and that is basically what we need to start phase one of the development. We're going to build a couple smaller buildings, build 2 triplexes. And so between the cash we have and that would be enough to build our first triplex. The thing is, it's collateralized over here. I'm going to get a bank loan to knock this out. I had a conversation with the lender, the seller financier, and said, hey, I need this money to go build. They're going to take that and actually move it over and put it in second on the duplex. I don't have the equity completely in the duplex. However, that individual has a clause in there that says we can only use the money to develop that site. And it is called due if we can't use that to build out the first triplex. So we're just using funny money, it's a promissory note, and we're moving it somewhere else when I go get a bank loan.
And why would they be comfortable with going into second position on development? Well, conveniently, they have the first on this one. We bought them from the same owner. So he's like, I already know the property, I know the project, he's going to actually help us build it. So he's not a partner, but he is a major player in the entire project. He's financed both sides, he's familiar with both assets, and he's going to assist us in the build.
That said, you can do this, whether it's the same owner or not, if you go through everything that we talked about and how we pitched the Robinhood. You go through your deal, the debt stack, the equity stack when it's done, and when we build the sixplex, it's going to create about $400,000 of equity. And we're going to borrow the majority of the build. So there's equity that's backing them on the back end, and so that makes them feel comfortable.
Is the seller, since he's helping you with the build project, he's making a pretty penny on the build too, or 10, 50?
He's not going to make a huge margin, and I've gone through a lot of his builds and his margins. This is where building those relationships can really come into play. He'll charge a really big margin for other folks, but he gives us opportunities because I reached out to him a little over 4 years ago, learned his story, how he got into it. He came from Iran, worked in a box factory, making a few bucks an hour. And if you go to one of his properties, there's actually still conveyor belts on one of the older properties because that was his weed guard. It was from the old box factory. What I'm getting at is we get opportunities today because we've spent the time and invested in relationships that get us a lower cost. He freed up his guys, he took them off of a job just to do this deal for us, and he's doing it just above cost. And anybody can do that, but I had to invest about half a decade.
Guys working and then get back to the project.
Mm-hmm.
Very good.
Yeah, but I had to invest about half a decade to get there. He wasn't doing that in the first couple of years. And I had to consistently show up and learn from him, apply it. And if you want to build trust, you want to build a relationship at the highest level, the way that we do it is we get a takeaway from someone, apply it, and let them know that it worked. Nobody lets them know when it works. They never go back and tell the folks that they're chatting with that, hey, I applied what you said, it did work, and it moved me forward. And if you do that, then it makes the relationship a little bit tighter.
I'll close on this analogy. For any of you board game players or any who've played like really any strategy game that is more than a 5-minute family game. Generally speaking, in any game, you have some evolution of you have X amount of resources, and as you play longer, you accumulate more resources and you have bigger plays, and then someone finally comes in and wins the game. As you're playing, this is why it's so important to get all those pieces. When you have multiple debts, multiple partners, multiple owners, multiple properties, it gets so much easier to come up with options that will work with everyone. Because the DDE thing is not just for real estate, that's for your debt stack, that's for money, that's for everything. You're going to figure out what is the opportunity, what does the other party need, what do I need, and can we put together something that all parties agree to. I mean, it's the basic deal making. But the more you do this and the more assets you have to move, trade, restructure, the easier this game gets. When you're starting, you have to keep it simpler because you just have to buy properties that cash flow on long-term fixed rate debt. That's all you have to do. And in that process, you're meeting owners, you're building relationships, you're stacking assets, you're getting partners, and you're sidelining money. It will get easier as you play it, which is why some of these deals, you see some structures in here where it's like, wow, that's kind of complicated. You want to keep them as simple as possible, but you get the option to do projects like where we're at as a reward for doing a few multifamily properties. We did, a couple 12 plexes, a 6, 2 sets of 6s, and a 38 plex, and that allowed us to do a larger project like this. And even when things didn't go as expected here, we were able to move our pieces and make everything happen. Going into next year, we're in a much better spot because the CapEx is now fixed. We brought income from 620 to about 720, and I am very, very, very confident that we will add another 100 to 150 going into 2024 to our operations now that we've fully converted into event space and wedding space that does a lot more than nightly rentals.